I'm Charlotte McLeod with the Investing News Network, and here today with me is Eric Nuttall, partner and senior portfolio manager at Ninepoint Partners. Thank you so much for being here online with me today.
Happy to be with you.
Yeah, really happy to be speaking with you. And we're going to be having a conversation about oil and gas. It's a topic that we don't get a big chance to talk about here on our channel very much. So we're going to start out with some basics. I was hoping we could take a look back at 2021 and have you look at the industry's key drivers and let us know where we ended up with prices just to get started.
You bet. So it's so much of the story around 2021 when it came to oil and the energy markets was the recovery in demand from COVID. We all know, and some of us are still locked in our homes with the kids homeschooling and such. And yet one day we hope, we'll be in a post-COVID world. We know throughout much of 2020, the demand shock from COVID resulted in demand falling by as much as 30 million barrels per day for a very short period of time. And so the narrative around 2021 was really the recovery of that lost demand. But at the same time, the bullish driver for the oil price was not as much the recovery in demand, but it's more on supply. And it's the reasons why I believe we're in a multi-year bull market for oil. What we saw throughout 2021, continuing into 2022, is the lack of significant production growth from all over the world. We can look at US shale, which were the culprits of leading the world into oversupply for about a 7 to 8 year time period. For a variety of reasons, I believe that era of hypergrowth is over, which is massively important because there was a period of time where without US shale, non-OPEC production would have actually been flat over a 10-year period. So that loss of US shale hypergrowth is a massively bullish event. At the same time, throughout 2021, you had the lack of production adds from OPEC. They just started late in the year, bringing on some of their curtailed volumes. And then we've seen the wokeness-driven lack of investment from the global super majors, usually based in Europe, that are wanting to get out of dirty oil because there's no future, of course, in investing in renewables. And so last year we had a pretty good year. We were the top performing energy fund in the world. We were up about 186%, and a lot of those gains was the realization that we'll be consuming oil for much longer than consensus believes, and the realization that the bludgeoning that occurred in these share prices in 2020. It was massively overdue. So those would be the primary drivers of what I had to deal with in 2021.
Okay, well, thank you for that crash course for 2021. Now we can take a look forward to 2022. And I wanted to start with supply side factors and what you're going to be watching when it comes to the oil and gas industry this year.
Yeah, it's when you analyze the oil market, it's actually remarkably easy to do. We've got demand, and then you want to talk about supply. So when we look at supply, there's really three buckets to look at. There's US shale, really. There is OPEC, and then there's everybody else. And so if you can analyze demand, which we'll touch on later on, I'm sure, and then those three areas, you've got the column nailed. And so when we look at supply this year, we referenced earlier, I think we're in a post-hyper-growth US shale world. And so what does that mean? While US shale will be growing, my guess would be by about 600,000 to 700,000 barrels per day this year, it's no longer exceeding global demand growth. And so there is a call on production growth from other areas in the world. So why is US shale not growing as much as it used to? The biggest reason is the old shale model was based on being able to access the debt markets and the equity market and outspending your cash flow every year. So if you as an entity, you generate $1 billion of cash flow, the average shale guy was spending $1.5 billion because the market was throwing hundreds of billions of dollars at them. The banks were willing lenders. Today, the market's closed. Everyone's still traumatized from the incineration of almost like $1 trillion of shareholders' capital. Banks don't want to lend. It's too volatile, ESG, they need to reach their own net zero goals. And so shale companies are constrained to underspending their cash flow. And at the same time, investors like myself say, why would you possibly grow when your share prices are so distressed in terms of valuation? Keep production flat, maximize free cash flow, and flow the returning excess cash back to me in the form of dividends and share buybacks. And you've really seen that adopted by shale companies. And so that's a watershed event, and it's a permanent state. Because for companies to want to ever be able to grow again, they'd have to go to guys like me and say, I know you've been liking this 10%, 12%, 14% per year yield, but we actually want that money back so we can go drill and grow production because we know how well that went the last time. It resulted in a price crash. And so guys like me would say, you're fired. And no, that's not happening. And so I really do think it's a permanent new philosophy, like discipline. This whole people worried, oh, when's discipline going to fade? Discipline is the new normal. So that's US shale. You look at OPEC. They, as a group, have had to deal with insufficient oil prices for the past 6-7 years. Well below fiscal break-evens. They've had to divest. They've had to borrow, etc. They've had the inability to invest in new productive capacity, and you see that today, where some countries are underproducing their quota, forsaking billions of dollars. Well, it's not for benevolence. It's not they're being good actors. It's that they literally don't have the ability to produce what they used to produce before. And so I look at OPEC. We think they've got spare capacity of about 3 million barrels per day. That's in the context of a 100 million barrel per day market. That's very thin, and they're officially bringing on 400,000 barrels per day per month. In reality, it's much less than that, because countries are, you've got a quota, you're allowed to produce more, but you can't because you haven't been investing for the past 4 or 5 years. Production capacity falls over that time frame. And so by the end of this year, I believe we will exhaust OPEC's spare capacity, and that will be the most bullish catalyst for oil in easily the past decade. The last element on supply to analyze there are the super majors, the Royal Dutch Shells, or it's Shell now, but they dropped the Royal Dutch after a court ruling. So we've got Shell, BP, those guys. And what have we been seeing? They've been insufficiently investing in production since 2014, when the oil price crashed. And today they say, well, look, our shareholders need us to reach net zero by 2050. We need to increase dividends. We need to do buybacks. We've got this guy in Toronto saying, we got to buy back shares and such. So what are we going to do? We're not going to invest in new oil production, right? Because who knows when peak demand is? It could be 5 years, 10 years. We'll discuss that later. So what's the path of least resistance? Stop investing and just, you want a dividend, we'll buy back shares, we'll invest in renewables, we'll invest in, offshore wind, et cetera. And so that group is effectively posting zero growth till the end of this decade. So for the next 8 years. And so in a world where I think demand is going to be growing for probably the next 15 years, and when you look at, historical growth's been 1.2, 1.5 million barrels per year, once you account for US shale, I cannot account for the majority of the remainder of necessary production growth. And so what does that mean? It means the world's hurtling into an oil supply crisis, and the oil price will have to go high enough in order to kill discretionary demand. And so the question you probably ask is, well, what oil price is that? And it would be an all-time high oil price. So we'd be looking at about $140, $150 per barrel, if not higher.
Okay, so you've laid out the supply situation pretty clearly there, and I don't want to take you on too much of a tangent, but when we hear about oil supply, one concept that comes up is peak oil. So I want to briefly get your thoughts on that. If it's a useful thing to talk about, what are your thoughts there?
So when we talk about peak oil, usually that's about demand these days. People don't reference peak oil for supply, but you could. One, you could say, well, it's geologically produced, meaning we've found the big fields. There is a base decline rate. Offshore is 10%, onshore is 4%. There's not enough new production from established fields to offset that decline, and therefore, M. Kim Hubbard, I think it was in the 1970s, I think he came up with the concept, Hubbard's peak, etc. I don't know if we're there quite yet. The discussion more practically today is on peak oil demand, which I think is a really good conversation to have, because it leads into what I coin energy ignorance, which is the lack of knowledge of how oil is used. And the second part of it is, well, what are the alternatives? And what is the reasonable, rational timeline for those alternatives to displace oil? Because you ask the average guy, they'll say, well, geez, Eric, 95% of oil is probably gasoline. And I hear I'm driving an electric car in the next 2 to 3 years. And therefore, we're not going to be needing this stuff. And yet when you delve into, well, how exactly is oil used? 60% is transportation, 40% is not. And so you think, okay, 60 transportation sounds like a lot. About half of that is cars. 27% of oil demand is cars. And yet when you think about numbers, I'm kind of a math guy. So you're like, okay, well, let's look at it. EV sales last year globally were 5 million. And there's 1.2 to 1.3 billion internal combustion engine cars to displace. And yes, that 5 million per year is scaling rapidly. And yet the math would say we're looking at least 2 decades before you reach the tipping point to really, really erode incremental oil demand from cars. You look at another alternative, hydrogen for heavy hauling trucks. Well, you're looking into the 2040s before companies can invest, so long as they want to, frankly, because it's going to be like a lot of renewables, is zero competitive edge product with minimal margins. You're seeing that now in offshore wind turbine manufacturers, like -2 to 2% on margins, worst business in the world, like worse than the restaurant business. So assuming companies actually want to invest, you're looking at the 2040s for hydrogen, renewable jet fuel, we fly, flights, discretionary cargo, et cetera. Well, that's 8% of global oil supply. You're looking several decades around. So that's 60%. And that's actually like the area that I'm most worried about, and yet I'm talking about decades. The 40% of oil supply comes down to things like petrochemicals, lubricants, plastics, some power generation, cement, agriculture. And all of the drivers of that 40% is population growth. And we all know, we need to reach net zero by 2050, et cetera. And yet the global population between now and then is going to grow by 32%. And so that driver of growth, the only way to shrink that existing 40 that's going to grow with population growth is to lower our living standards. And that's not something that anybody is willing to do. We're not going to all be eating bugs. And, I saw a storyline this week. Maybe the cold is good for us. Okay, I don't think people want to live in the cold for the benefit of the climate, et cetera. So when you take a pragmatic, rational viewpoint, you and I will be consuming oil for the rest of our lifetimes. And so the bullish thesis revolves around demand growth for at least the next 10, 15 years. And yet another line of coin is the fear of peak demand is leading to the reality of peak supply, meaning the fear of the unknown. Is it 5 years, 10 years, what's the oil price going to be, is leading to the reality of peak supply today because companies are just not willing to invest. And shareholders, I run one of the largest energy funds in the world. I don't want guys to grow. I want them to buy their share prices or their stocks to get a re-rating from the valuations, which today are the lowest that I've ever seen in my 19-year career. And so that's what excites me about the energy trade in 2022.
Yeah, and these are some really great points. I think definitely with the focus on ESG and green energy that's really coming to the fore today, we do have people who think, oh, I like oil and gas, I guess we're not going to be using them for very much longer. You mentioned, so we've got 10 to 15 years or so more of increasing demand. Can we look a bit more closely at what demand will look like in 2022 and what you see there?
Yeah, it's really tough on the short term because we've got Omicron, impacting discretionary travel. In the very short term, we actually reached pre-COVID levels right before Omicron broke out. And personally, I'm an optimist. I think what we're seeing is people want to travel desperately. So global diesel, global gasoline markets were back to pre-COVID. The only remaining weakish market is for jet fuel. As you can imagine, that people aren't flying as much. Military strong, cargo strong, business travel sucks. Personal travel is pretty strong. So I think we'll be growing this year, I don't know, by 1.5 million, 2 million barrels per day. Depends on what base you're using to account for. And it's really getting back to historical normal, once we get in a post-COVID world, when we move from pandemic to endemic, and we can all return to our old lifestyle. Because, how often did you have to listen to throughout 2020, like the new normal, the new normal? There is no new normal. And yes, you and I are doing this over a video conference. I'm working from home for the next month, et cetera. But what we saw in the data was that there was no impact really in oil usage over that time frame. And so, while I didn't drive to work, there was other uses of the car that overwhelmed the demand destruction that we had there. So I think any waves going forward, you can see it already. People are just tired. They've had enough. The market's rallying on Omicron cases, rallying, et cetera. It's just, I don't think it's a driver anymore.
All right. And looking a little bit more closely at prices for 2022, I know you mentioned in the future a record high oil price. What is the coming 12 months looking like in your opinion?
Yeah, so we're sitting at about $78 to $80 right now. I think that's a healthy level, frankly. Like we've got some geopolitical risk in Kazakhstan, some in Libya. I'm comfortable with 70 to 80 for the first half of this year. The price does not have to go up for oil stocks to go up anymore. Like when I look at valuations even using 70, that's kind of mentally what I'm using for investment decision making for the first half. Stocks are incredibly mispriced. I'm looking at, on average, companies could privatize themselves and pay off all of their debt with about 6 years of free cash flow at $70, so $10 lower than where you're trading. That's insane. So I don't need the oil price to go up for energy stocks, I think, to go up. But I think we'll see, 70, 80s, I think a pretty comfortable level for the first half. As we get near to the exhaustion of OPEC spare capacity, which again will be the biggest bullish driver to the oil price in like 10 years, if not longer, I think we'll be well in excess of 80. I think we've got a shot of making 100. People love round numbers, the triple digit magical 100. Who knows? Markets always undershoot and overshoot. They sure as heck overshot in 2020 when we went negative for a couple hours. But that's my general thinking. And with that backdrop, energy stocks are so mispriced. And I can feel the performance anxiety on the part of the generalist investor already. Where most guys were underinvested. In Canada, it's a larger part of our index, less so in the S&P 500. And yet, I was driving the car today, listening to other media channels, and it was just energy. That's all they were talking about. It's been a long time, and it is such a massively under-owned sector, where valuations today are the most compelling pretty much I've ever seen them, using an oil price $10 lower than where we sit today, which gives me such a huge margin of safety and free optionality to higher oil prices. Like usually, in euphoria, you're embedding a meaningfully more bullish reality than what you're living. Well, today we're discounting a meaningfully more bearish reality because, again, the average person out there, not for their own fault, but it's just what the garbage that they listen to every day from the uninformed. Well, geez, we'll be driving electric cars and we're not going to be using this stuff. You look around your office, you look around my office, every single thing you see is either made of or require the use of oil, literally everything that I look at there. And so it's so ignorant to think that we're not going to be using this stuff in 2-3 years. And with the population growing by a couple billion people, how can you tell me the demand's not going up?
Right. And let's definitely take a look at the investment angle here. I was reading one of your recent Financial Post columns where you talk about the opportunity in small Canadian oil and gas stocks. So I want to ask what appeal you see there specifically.
Yeah, so I referenced earlier, like we had a pretty good year last year, #1 energy fund in the world. And a large reason how we achieved that was going where people weren't looking. It's so most people, they've social proof, the comfort of following the masses in times of uncertainty. And yet I was always taught early in my career is if you look where people aren't looking, like that's usually can be where the opportunity is, so long as you do your homework. And what we found then and what we find today is that you can buy businesses, with market caps of 1 billion or less, even as high as $3, $4, $5 billion. These aren't tiny companies really. And yet, because they're small, there's not as many people looking at them. And so that means they're trading at literally, if using today's oil price, close to $80, I could buy businesses trading at 2.5 times their enterprise values, their market cap and their debt, divided by their annual cash flow. And yet, on average, they're sitting on 16 years of reserves, so drilling locations. And so if you forget about its oil, if you just use the analogy, well, they make widgets, okay? So they sell widgets today for $80, really fat margin, very profitable. And, at the current oil price, the widget price, that company could buy back all of their shares outstanding and pay off their debt with 4 years of free cash flow from selling widgets, but they've got 16 years sitting in a warehouse. So, simple math is 60 minus 4. In today, using the current price of widgets, because it's so profitable, I can get 12 years of widgets for free with almost no risk sitting there in the warehouse. And by the way, I think the price of widgets is going up meaningfully between now and the next couple of years. And so the risk reward for me in this sector is incredible. My biggest challenge is everything looks good. Large caps look good, small caps look good, oil looks good, natural gas looks good, services look good, offshore drillers, like everything looks good. And so the job of a professional for energy portfolio manager is to figure out, okay, where does it look best relative to the risk that I'm taking on? And so I can buy smaller businesses today with incredibly strong balance sheets. Most guys paid off debt last year. So, last year's return to the debt holders by paying down debt. This year it's return to the equity holders, the shareholders, through meaningful buybacks and dividends. And so my ask, again, as one of the largest energy funds in the world, is guys, like I, meaning for my investors, we want half of the free cash flow. And I want it in the form of buybacks. And once you've re-rated your share price, then we'll talk about dividends. But companies have the power to drive the re-rating in their valuations from currently depressed and depressing, frankly, valuation levels by buying aggressively their shares in the open market using the free cash flow that they're generating. Because the free cash flow being generated by the industry today is the highest on record.
Okay, that's really helpful. And I wanted to ask, you have a great problem if everything out there looks good. I was hoping you could go into some of the criteria that you look for when you're looking at oil and gas companies. And just for context, I think our audience is probably more familiar with looking at junior mining stocks.
Sure. Yeah, so I can use the analogy of mining because a few of my colleagues from prior lives were big mining investors. And one of my first criterion is management. And again, wisdom comes from making mistakes. And I've had 19 years now of making mistakes. So you try not to repeat them and you learn from them. And anytime I invested with somebody I didn't trust, I generally lost money. And it's really may sound simplistic, it may sound whatever, but that's my golden rule. I only do business with people that I trust. So I start there. Then you dig into the assets. I look at payback periods, meaning how long does it take a company on the average well that they're drilling to get their money back. So you spend $2 million on a well. Okay, well at 70, how many months or years does it take to recoup that? And so you want the faster payback, the more free cash you have, the quicker you can grow production, or today, the more free cash that you have to buy back your shares. I model out every company, not only that I own, and at least in Canada and the United States as well. So I can see, okay, at 50, 55, 60, up to 80, how much cash flow and how much free cash flow we're going to generate. And so last year, and similar to this year as well, I'm looking for names where there's a strong inflection in cash flow and free cash flow for a small change in the oil price. And so you look at that. I look at trading multiples relative to how many years of reserves they have, how many years of drilling inventory they have, and you kind of put that together. So I've got all my models, and then to boil it down, I literally have an upside tab in my master spreadsheet, and it uses my own internal price targets, which we're not allowed to talk to, but I can see in real time, okay, what's the realistic upside for every stock that I follow? And then we're always rebalancing my fund to be exposed to the very best ideas. That's generally in terms of how we do it. So we marry the macro, like our call on oil, natural gas, and then we do the micro on the companies, and you kind of put those two together.
Okay, perfect. This is coming to the end of my questions, but before we let you go, is there anything else that you would want to tell investors about your fund or about the oil and gas markets as we're heading toward 2022?
Yeah, so we had a good year last year. We've got a pretty good historical track record. I run the largest energy fund, I think, in the world, and also the number one performing energy fund in the world. And then our style is a little different than anything you'll ever see. It's a focused basket. We typically would own 12, 13, 14 names. I'm not a believer in diversification, owning 50 names, because I can't have an edge in those. Leveraging nearly 2 decades of doing this by knowing management teams, being early on plays, having conviction, and trying to seize opportunities. And I'm working a little bit harder than the average. So I'm really, really proud of the numbers that we put up on the board, not just last year in a good year, but also, in a down year like 2020, we still beat our index. We were only down 22 in what was like a bloodbath of a year. And so the last message I would say is I feel very confident that we're in a multi-year bull market for oil. Energy stocks, despite the run, still, in my opinion, represent a generational opportunity due solely to energy ignorance. People, frankly, are clueless in terms of how oil is used and how long it's going to take to displace. And so for every time you hear a storyline, every time a politician is yammering about hydrogen and the new economy and energy transitions, I can assure you, as a guy that looks at numbers and looks at our energy reality, we will all be consuming oil for the rest of our lifetimes. And yet that fear of peak demand is leading to the reality of peak supply. The writing is on the wall. We're heading towards an oil supply crisis. And given the current valuations of energy stocks, you're absolutely getting free optionality on my bullish thesis.
Okay, well, thank you so much. We'll leave it there for now. It was great to hear your thoughts on what's going on. I think that was super useful.
Happy to spend the time with you. Thanks.
Great. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Eric Nuttall with Ninepoint Partners.